Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by my company, Bull Realty. Check out bullrealty.com for customized asset and occupancy solutions, or give me a call personally. Today we're talking about industrial real estate. My guest is KC Conway. He's Chief Economist with CCIM. And KC, a lot of people are concerned about the cycle. We've had a wonderful 10-year run here. Some people think we're at maybe we got to be getting close to the end of the cycle here somewhere, right? I mean, I'm hearing people say things could change in 2020. Heck, that's a year away. What do you think, and what's the impact on industrial?
Yeah, so what I would say is things could change next November, the elections. But as far as the fundamentals of the economy, and we have a little thing going on today and tomorrow, the Fed meeting to, if you can just imagine this, cut interest rates. This isn't 2008 again. And it has nothing to do with our economy and needing to stimulate the economy. And we just had the first read on second quarter GDP. It wasn't the 2.5 to 3 that we were hoping for, but it was 2.1. The good news in that, inventories declined. That means we got to fill up those warehouses with stuff for the holiday season. The consumer was incredibly strong. The numbers on that were over 4% growth in consumer spending and related. So consumers not grumpy or unhappy. They're going to spend like the dickens this month on back to school stuff. So, if you look at it, GDP is good. We're still producing on average 175,000 jobs a month. We'll get a new jobs number this Friday. I don't think it'll be over 200. It never really is in July. The August number can get crazy because they can't figure out whether the teachers were off work or back to work, and where'd all the college students go. So jobs are fine. We have more job openings than we do have unemployed people in this country. We're seeing people come back to the workforce. We're seeing labor participation rate rise. We're seeing home prices go up. We're seeing wage growth at 3%. I mean, does that sound like 2018? Does that sound like we need a rate cut? Absolutely not. So the fundamentals are very good there. The good thing we have going for us in commercial real estate, and really even residential, is we're not overbuilding. Yeah. So you look at single family housing, right? We can barely struggle to build 1,000,001 units. About 400,000 of those are multifamily. That's nothing like the 800,000 we did in the 80s a year, or even 600,000 before the financial crisis. So we're not overbuilding housing. Builders and developers have realized that the grocery store model doesn't work. I'll make up for it on volume. So I'll take all this risk and make a 2% margin. I said, no, I'm just not going to build and take that much risk and have to use more equity because the banks won't still lend to me because I'm still in that awful thing called commercial real estate. So we're not overbuilding. You look at the commercial real estate property types. We're not building spec office buildings. You've got to have lead tenants or whatnot. We're all skeptical of the co-working issue. Is it real or not going to be real? You look at industrial. Look at the numbers: vacancy, absorption, rising rents. We're at the early phase of really shifting everything from online and retail really into a warehouse box. So I feel very good at that. So why is the Fed going to cut rates? The Fed's going to cut rates because they weren't happy with their two roles. So their two primary roles given to them by Congress are price stability and maximum employment. They said, we're bored with that. We want to take on a third one. We exported this thing called quantitative easing to the rest of the world, and they've gone nuts with it. And so we're paying too much of a premium on our debt that we issue compared to the rest of the world. So this will knock your socks off. We have $13 trillion of sovereign debt yielding a negative number right now, which means you give them $100 and they'll give you maybe 85 or 90 back after 5 or 10 years. How do you like that deal? Yeah. Most all of Europe, Japan, it's nuts. It's 1 in 4 of every sovereign debt dollar is negative yielding. So if you're the United States and we're the growth market in the world, we're the only place to live in growth, and you're offering somebody a 2% yield on their bond in a currency or assets that aren't devaluating versus you're in an economy that's not growing, your currency is devaluing, what do? You just throw all this cash in the United States. So the Fed is saying we gotta prick that. And because it's creating asset bubbles. The stock market's rising too much. Commercial real estate prices are rising too much because we're too attractive. And so they think that we're going to reverse engineer QE by doing more QE. I just think this whole QE experiment eventually ends very badly. But that's why the Fed's doing it. They're concerned about this flow of capital into the U.S. and trying to slow it because we're paying too good a premium.
And most people in commercial real estate in general, kind of like the ideas of lower rates. Where's the challenge?
So I think what folks need to realize is what happens if you're a developer, if you're an investor, your real actual rate isn't going to collapse. Because what do? We increase the spread because everybody knows if I've got to hedge that loan or I got to put a swap against it, I'm worried that they're going to change their mind. I mean, look at where we were a year ago. We're heading to 4 rate hikes, and now we're talking 3 or 4 rate cuts this year in a 12-month period of time. I mean, seriously. So, that's why when appraisers always tell me I look at the spread between the 10-year and, and the cap rate, and it should always be 300 basis points. I want to just, strangle them. those comparisons and metrics are long gone. In the debt market, in the equity market, they're looking for an all-in yield, and they don't care what that treasury is bouncing around. They're still going to get their 200 or 300 basis point spread.
Yeah. So negative impact on commercial real estate if rates are reduced some, maybe not much impact at all?
Yeah, it's not. It might help the housing market a little bit. We get back to mortgage rates where we were before all of this Fed hiking. So that stimulates some things, makes retail work. Consumers buy more, the warehouses fill up more. So there's that aspect. Retail, our problem in retail is that we're over leveraged. It's not Amazon or online sales. We've only got 10% of our economy in online sales. You look at most retailers that are in trouble, it's because they got over leveraged. Going back to the 1980s, KKR, leveraged buyouts, we're still living through that. Why is a Barnes & Noble still alive and functioning and a Toys R Us not, or trying to reinvent itself? Toys R Us was just leveraged to the gills with debt, and Barnes & Noble wasn't. So they've had opportunity to not have to, fret over creditors and re-experiment with what they're doing. So I don't see us in a bad shape.
So what do you think about the cycle now? Are you on the bandwagon of 2020? We're going to see some adjustment here?
So it's a real wild card with the elections. If it were an election year, I'd say I could see this running another 2-3 years. The elections are a wild card out there. You look at what's going on. I sure don't want to. I'm going on permanent summer vacation next year because I don't want to be around during either political convention. It's going to be very. It's not going to be entertaining. It's just going to be like a, all-star wrestling match in this corner and that corner and crazy mass and throw around. The fundamentals are there for this to go another 2 or 3 years. They really are. No overbuilding, ample capital. We got plenty of capital. I mean, if you can't make a deal work today with a 2.5 to sub 3% 10-year treasury, you just need to get out of real estate. You don't get it at all. Just go away. It's just not that difficult, and the fundamentals are good. We've got rising rents, low vacancy, capital that loves you. The bank's needing more loan growth, so they're starting to love commercial real estate a little bit more. Life companies are there. Securitization market's wide open. Here's what I think is the real risk. So as we're building product today, and you've got a construction loan, construction costs are rising during that 2-year period a lot more than your NOI or your pro forma rents are going to be. So we're seeing construction costs rise 10 to 15% a year right now, primarily because we're rebuilding from 5 Category 3 or 4 hurricanes. There's no labor, there's no materials. If we have another active hurricane season this year, we're in real trouble. So if you're a developer, your biggest risk needs to be cost overruns, material order changes, labor shortages, not delivering the project on time, having to go into your interest reserve. So I think the lenders, I was talking to the bank regulators yesterday in Washington, D.C., they're clueless about construction loan risk. So that deal that you did is a 75 or 80% loan to cost deal and whatnot. You've averaged along with 2-3% rent increase, but your construction costs are up over 20%. You now need to move that out of the bank into a permanent loan. And I think your ability to move into the permanent debt market is going to be more challenging 24 months out because the asset isn't going to be there in the price. You just can't change the performance and say, well, I'll just charge more rents because costs went up 20%. We're seeing in the commercial property price indices, the 2 I track that I think are really good, RCA's, Real Capital Analytics, and they do it market level by market and property type. And then Green Street Advisors does a good one. And what they're showing is all that CPI is flattening. We just can't get as much juice. Businesses are squeezed. We got all kinds of margin pressures and efficiencies. So I don't see NOI going negative, but I see it growing a lot less, like low single digits. And I see the cost to replace these assets or build them going up at 15 to 20% a year. That's the big risk.
Yeah, and that would be interesting, the impact of that rising construction cost on the value of existing supply. And we would think it would slow down new supply. And help existing supply. So you think that we have 2 or 3 years of good fundamentals, but the wild card is election year. Yeah,
I mean, look, we passed a tax act in 2017 that was like 5 Christmases at one time for real estate. We really benefited. We're just getting into the rhythm mode of opportunity zones. The rules are kind of out. I was at Harvard a couple of weeks ago with Steve Glickman, who was one of the original architects of the program. And it was really interesting to hear him because he explained, we're trying to understand all these year dates in the opportunity zones. Like you've only got 7-year deferral on your capital gain, and you got to hold the asset for 10 years. And why did they pick those numbers? And what was fascinating was it all had to do with how the Congressional Budget Office scores the Tax Act. So by holding something for 10 years with no capital gains, there's no impact on the economy, on the budget. So it scores 0. But if you go longer than that, now there's an impact. If you do the deferral longer than 7 years and don't recapture some of it, then you've got a problem. So all of this stuff in opportunity zones, the dates, all had to do with how things get scored in the Congressional Budget Office. So, I think there's just a lot of other stuff going on. The fundamentals are there. The fundamental change we have in retail, like I said, really the shift to e-commerce and online is something that's going to drive industrial for years to come. We're only at 10% of retail sales. My latest report showed that I see that doubling over the next 3 to 5 years, going to 20%. And I think we could end up somewhere near 30, 40% before we're all said and done.
Wow. And you mentioned rising cost on all properties, but industrial as well. And some of that's based on the new industrial properties aren't what our dad or grandpa built, are they?
No, these are like law firm finished out offices.
Yeah.
The construction features and design in industrial today is nothing like what we grew up, where you just go plow some dirt out in an industrial zone or, that the local economy had done and tilt up some concrete walls and put a built-up composition roof, and away you go with maybe 5% office. These are pretty high-tech facilities. So let's start at the foundation. You're looking at the concrete floor. These all have electronics in them today, so they can run robotic forklifts and everything else. So the new flooring system is something like a ductile concrete flooring, where it doesn't have the seams and the kind of curling that occurs in concrete that messes up electronics and the forklifts. So that flooring is more expensive than a traditional one. The roofs, we're putting, because of energy efficiency, we're putting more skylights and things in the roof, so the membrane system is more complicated. It's got more holes in it. The technology in these things for the conveyor systems, the electric loads, all that stuff is a lot more. So I shared with you earlier, I'm on a public REIT that is one of the landlords for FedEx, and so we get the opportunity to buy and provide a few of their new e-commerce buildings. And what we see is every new building year after year goes up very substantially in construction costs. And we're seeing this as well when I do work or work with colleagues on Amazon or Home Depot or Walmart. A building that used to cost $60 to $80 a square foot to build, with all the bells and whistles today to do e-commerce right and operate 24/7, that building today is $100 to $125 a square foot.
Wow.
And the amount of land that's needed is different. We used to build these things on 3 to 4 to 1 land or building ratios. Try 7 to 1 now. For all the e-commerce, the extra truck packing, the bigger courtyards, planning for autonomous trucking, all of that's changing. And now we're seeing, because the land's so expensive and scarce in big markets like New York, New Jersey, LA, Long Beach, we're seeing industrial warehousing going back to something that Sears created in the 1930s, and that's vertical warehouses. So there's a great example in the Red Hook market of Brooklyn that's being done by Goldman Sachs and a property developer that's a vertical modern e-commerce warehouse. And it has different ramps that go to different levels. So if my level is Amazon, I'm on the 3rd level, my ramp comes up there, I can do all my stuff in 200,000 square feet. If the 2nd level is Walmart or Target, then Amazon can spy on them below and they can have their ramps. And that thing cuts the land of building back to 3 or 4 to 1. That thing is going to cost probably $200 a square foot to build. Wow. So this isn't your father's or grandfather's or a caveman's industrial building. This is very expensive stuff.
And I guess that's going to be built fairly close to the large cities.
It is. Like they're billing it as, it'll be the tallest industrial distribution center in the East Coast with the closest, fastest last mile fulfillment. So right there in Brooklyn, it'll be able to do everybody within about 2 hours is their objective. Yeah,
that's amazing. Well, what would you leave our audience with, KC, related to industrial real estate and kind of a forward forecast, if you will?
Yeah, so I would say, look, if you're in another property type, reclassify it in your marketing as warehouse. So if it's multifamily, you're warehousing people. The capital and everybody loves warehouse, so just change your property classification to warehouse. Second thing is we're very early in the transition from a shop and pick pick up to an online order and deliver to me. This is something that's going to take us more than a decade to do. We're just beginning to figure autonomous trucking out. In fact, Florida just passed legislation to become the first state that by next year will allow full use of autonomous trucking statewide. They dealt with the liability issues, the infrastructure, all that type stuff. So Florida will become very attractive. And we're seeing major companies like Home Depot go into Central Florida. Anybody that's listening from Winter Haven and Central Florida, it's really the Inland Empire of California. We're also seeing, through the reshoring, manufacturing and supply chain are looking for affordability. These warehouse, e-commerce, and manufacturing workers make $20 an hour or less, and they need to be in affordable markets. And so we're seeing places, whether it's Ogden, Utah, Rockford, Illinois, Talladega, Alabama, Greenville, South Carolina, North Carolina. These are the under 300,000 population, but they have really good logistics infrastructure. They can tie into the rail, intermodal rail. They know their connectivity to ports. And they have workforce affordability. They can afford to own a home. So really pay attention to the logistics infrastructure. In fact, I would say that's the one measure that most appraisers and analysts don't look at today. They don't have a module that looks at logistics infrastructure, metrics in there. And then I say the innovation in the product and industrial is going to be mind-boggling. The last one, so those of you that may own or have clients with older warehouse industrial, don't fret. It's still very much loved. We don't build any new multi-tenant, 10 to 20,000 square foot bay industrial. We benefit here in Atlanta. We have a great colleague we know at King Industrial, Sim Dowdy. They study the Atlanta market, 750 million square feet. 80% of all the leasing and sale transactions are to properties that are under 25,000 square feet. So we have a lot of these smaller businesses that are trying e-commerce, that are experimenting. They're terrified of Amazon. So they're going to new fulfillment platforms like Shopify. And so we're going to see a lot of change, but these well-located, low clear ceiling height, in town, close into infrastructure, older warehouses, the numbers are incredible. There's almost no vacancy. And the prices now we're seeing $50, $60 a square foot for this older stuff. Yeah. So don't give up on your older industrial.
Final question for you, KC. Let's say that we do have a recession come in 2020 or 21 or 23. I think investors out there and developers, lenders, officers looking for, well, what's most resistant to a change in economy like that when it comes to sector? You mentioned that there's a lot of growth expected to continue on the industrial side, on the warehousing and last mile and all that. When you look at the various sectors, which sectors do you feel most comfortable with in a downturn at this point?
Yeah, so the answer might surprise you. So as long as everybody classifies everything as warehouse, we're all good. Even hotels, we're nightly warehousing people in hotels. So I think industrial is because of what's driving it. And what's really driving it is the new big box, the new department store, the new grocery store. It's all in a warehouse. It's all about fulfillment. So we're early in that transition and phase. What I would look at there is, we've just celebrated 120 months. Right, so this is the last day. We'll have 121 months, the longest recovery ever. We've had a recession every decade since 1857. So we're overdue. It's like you're living in Southern California and you're 100 years overdue for a big earthquake. It's going to happen, but we don't know when. I think as we go into this next recession, this could be a more normal short cycle recession. Any of the phony things that we had in the last really bad ones of the Great Recession, we had phony mortgages with subprime. We had overbuilding, even in commercial real estate, because commercial real estate was following the rooftops. We hadn't really even invented online e-commerce yet. Amazon had figured out books and music, but hadn't really totally destroyed them all yet, now that they have. Smartphones didn't really even exist until 12 years ago. So when you think of the pace of the technology, autonomous trucking, Walmart's already moving autonomous trucks across the country. UPS is experimenting with them between Phoenix and Dallas. All this stuff is happening. It's happening real time and at a quicker pace than we all thought. And so I think the biggest challenge for us to look at are twofold. You've really got to understand and put back front and center highest and best use analysis. So when you're out there looking at a building, you really need to think through what is the highest and best use? What's the highest and best use for an empty department store, or a mall that's gone empty? Well, we did one at Monmouth outside Dallas in Mesquite, Texas, and we made it into a fulfillment center for FedEx. The whole mall, 800,000 square feet, and it's working out great. In Nashville, they converted 100 Oaks Mall to all medical with Vanderbilt University. So we've got to go back. We haven't really taught highest and best use very well. So I would really encourage you to take a refresher on highest and best use. The second one would be look at replacement cost on every deal you're doing. Because when you're wrestling with, is this cap rate too low? Or, is this price per square foot too high? The answer to that question is replacement cost.
Yeah.
And if you look at those numbers, if you're putting up a building today, that building 2 years from now is going to cost probably $15-20 a square foot more to build.
Yeah.
And you kind of have a self-insulating benefit and mitigation there. And then I think the third thing is you do need to pay attention to the fundamentals. I don't think it's a 1, 2, or 3 year period away that we overbuild, but we will overdo it. We'll go to 500 million square feet of e-commerce warehouse, and it'll be led by those guys in Texas. Dallas is #1 in the latest Colliers report, most amount of new construction. And as we go vertical, we're going to find new ways to justify the performance. So really go back and challenge those old school techniques, replacement costs, highest and best use. Stay in touch with your lenders. What's going on in the banking industry really concerns me, whether it's the consolidation, what they're laying off jobs, they're automating everything to artificial intelligence. So your ability to have a credit relationship is going away. You're going to only find that in a smaller or maybe a smaller regional bank, but the top 10 or whatever, 15 banks, it's all automated, artificial intelligence, credit underwriting, credit scoring, computer will spit out an answer. So build diversity in your credit relationships for debt and equity.
Yeah. Good advice, KC. Good information as usual. Thank you for joining us here in
Thanks.
Studio One.
I appreciate it.
And thank you for joining us around the country, whether you're listening on your phone or watching a video. We appreciate you being with us. And thank you for sharing the show and commenting. And please connect with us on LinkedIn and Facebook and on Twitter. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com. Red IQ, turning multifamily data into actionable intelligence. Visit rediq.com.